Hi, it's Mr. G here, and today we're going over accounting controls for cash. So we're talking about internal controls. So you have to have internal controls, and that's often when you'd have say a CPA or whoever come into your firm. They have to set up a system, and a bunch of internal controls to ensure that employees are honest, that you basically try and make everything as accurate as possible. I have a lot of employees, they made mistakes all the time. It was honest mistakes. They punched something in wrong, but you have to be able to count that. So you want to try and help to get as much accuracy and efficiency as possible. And so you have to have these internal controls. So internal control is the set of accounting procedures established to protect the assets from theft and waste. Okay, so you want to protect basically your assets from being stolen, being wasted, ensure accounting data is accurate, and encourage efficiency, and adhere to company policies. So this is what internal controls are. And so a CPA would come in to the firm and basically establish this. No internal control is necessary in small businesses where the owner functions alone, because essentially if the owners operate on their own, they know all the, everything that's going on. But even in those situations, they go away on holidays, they want to make sure that, things are still being followed. Having some internal controls would be required, but obviously a larger business, a Costco, whatever like that, they would need a lot of internal controls. As the business grows, employees are hired, accounting controls become necessary to manage the business. When there are a large number of employees, a good system of internal control is necessary. The larger you get, more controls you need. Fundamental rules of good internal controls are, where possible, two different people should be processing and preparing accounting documents independently of each other, and their work must agree. One thing I often do with students is, even if I have a test, I have them basically do it if I haven't worked out the answer key, and then I can look at basically the answers. Why? Because here's all these people preparing it. They should come up with the same conclusion. If they don't, obviously they made a mistake. And so then I go through and see that it is correct. But essentially, everyone should have that as if they're following proper accounting procedures. The person who recorded transaction or prepares accounting records should not also control or handle the physical assets. So you don't want to create a situation where people can change the books, because that's often how you catch things, and then they also handle the cash. So you want to separate them, so that they don't have ultimate control over all these things, so they can hide things, okay? So you want to have that basically in place. Fundamental rules of good internal controls are all assets should be kept in a safe place. Two authorized persons should be present when negotiable assets are dealt with, which are, anything that can be easily converted to cash, okay? Only a few employees should be allowed to approve and authorize transactions. And usually in large stores, you'll usually have the manager who has to come around and override things. And they're the only ones who are allowed to. So if there's a mistake or something happens, you don't have to go after the other cashiers. You go over the manager who basically punched in the code. So you're going after one person and, trying to figure out who else did it. Fundamental rules of good internal controls are an independent public accountant should periodically carry out an audit to ensure the accounting system is being followed correctly. So even after creating a system, a CPA should come in and then audit the whole system to make sure that everything is working as intended, that there's no problems, that you have good internal controls. If weaknesses are found, they can always be improved. Responsibility should be clearly established and should be easy to tell who is responsible for errors or missing assets. When you have hundreds of employees, everyone will be like, well, that wasn't my fault, but you should be able to, in a whole company like that, be narrowed down to one or two. It's like, no, these two people are the only people that are responsible for this, so we need to talk to them. Internal controls affect all aspects of a business, but is specifically needed for cash. The following internal control measures are specifically designed to protect the cash of a business. So we talked about internal controls. Now we're looking at one of the internal controls we can use to just protect cash. Okay? So separate duties. Deposit funds daily. Don't have lots and lots of cash around. Whenever you get any large sum of money, you want to make sure it's deposited. Deposit funds intact. What does that mean? Well, you get, say, a deposit on a car from someone in cash for $4,000. And then you have to pay some bills to someone or make some change, and you got all this 4,000 cash here. You're like, well, it's just easier to take the money out of this 4,000, give the change or fill up my cash register or whatever else you're doing. But the problem is then you have this envelope that with 3,390, and then where did that rest of that money go? It went into the cash register, but then you have to account for it, and it's just easier to put things back intact and then take a check and have it used, say, to replenish, your float or whatever the idea is, so that, basically where that money is. You have a paper trail. So deposit funds intact. Make all payments by check or electronic transfer of funds. Don't pay cash. You cannot track cash. Okay? And some people like it for that reason. But essentially, if you're wanting to have proper internal controls, you should be having checks. And endorse the checks for deposit only. Once a check is endorsed, anyone can cash it. So if you put for deposit only and in your bank account, no matter if someone finds it, whatever, all they can do is basically put it in and it will be deposited in your bank account. So that's a good internal control. So, if the owner signs on it, an employee can't just take that money and put it into their own account. Prepare deposit slips in duplicate. Make sure everything the amount you're depositing is the same as what actually goes in the bank. And reconcile the bank accounts monthly. And this is what we're going to be dealing with, is bank reconciliation. Okay. So we're going to quickly go through these ones again. So separate duties. The same people should not handle the cash. Keep the records for cash. Deposit funds daily. Total cash receipts for the day should be deposited by the end of that day. This minimizes cash on hands and discourages theft. That's another thing. A lot of money on hand, criminals can know about it, and you're more likely going to be a target. Cash received during the day should not be available for making payments or borrowing by employees. Make all payments by checks or electronic transfer of funds, except for petty cash expenditures and cash refunds. Payments are made by check or electronic transfer of funds. This allows the use of bank records to collaborate company records. And you want all this paper trail to prove what's happening. Okay? If you just did cash, it's much easier for people to hide things. You won't know what's going on. Endorse the checks for deposit only. Ensure each check can only be credited to the business bank's account. The deposit slip shows the detail of the deposit. Great for dealing with any questions. The teller should stamp the duplicate as evidence the deposit was made. Because if you have a large sum of cash, and then the bank's like, oh no, we only got $1,000 from you, and you're like, well, no, I put in $2,000, and then it's your word against theirs. So you want to make sure when you're depositing, you both agree on the amount that's being put in, and that's the amount on your deposit slip. And bank reconciliation, the process of comparing the company's records with the bank records to ensure all differences are accounted for. The bank records act as an independent verification. And that's why we do bank reconciliation. And it is really important. I did bank reconciliation all the time, and it helped me to find error after error after error that was basically put in, and I had to figure these all out to make sure it actually reconciled. And it's often a time-consuming process, but it is one of those internal controls and is necessary. Since both the bank and the company keep a record of cash, you might expect the month-end balance shown by the bank statement to agree with the month-end balance in the general ledger. This rarely happens, and I would agree I've never had it happen. The accuracy of both balances is proven by a process known as bank reconciliation. A bank reconciliation is a routine procedure to determine why the balance on deposit in the bank does not agree with the balance in the general ledger, and we'll talk about why that is. A bank reconciliation statement is a statement showing the causes for the difference between these two balances. Even in computerized systems, you still have bank reconciliation. So you still have to do bank reconciliation, with those systems. And so the only thing is you're able to check it off and still do the same kinds of things. But bank reconciliation is necessary even in computerized systems. So steps in preparing a bank reconciliation statement. First, step 1, have the following records available. The bank statement and related data received from the bank. The bank reconciliation statement for the previous month and a printout of the general ledger bank account. Okay, then we write a proper heading Divide the page down the middle, write bank records on one side, company records on the other side. Step 3, enter the ending balance from the bank statement and general ledger under the appropriate heading. 4, search for and identify all the discrepancy items causing the two balances to differ. 5, record the discrepancy items on the reconciliation statement, adding or subtracting them as necessary until the two balances are shown to be equal. So what do we talk about with discrepancy items? Well, first of all is outstanding checks. Checks that have been issued and recorded by the company, but not yet cashed by the bank. I used to write a lot of checks to outside agents, etc., and they would be notorious not cashing them until months later. Well, every month I'd have to be like, okay, why is my bank account higher? Oh, this check wasn't cashed yet. So that's the reason for the difference. And so those are what we call outstanding checks. Checks that you've given to people, but they have not yet cashed. Late deposits. Deposits that are made and recorded by the company, but don't appear in the bank statement. So if you put your deposit in end of the month and the bank only recorded it for the next month, it doesn't appear on the bank statement, even though in your general ledger you put it in for this month. And so essentially that's what we call a late deposit. Debit and credit memos. Common debit memos are interest charges, service charges, other authorized deductions from the business accounts. Interest earned is a common credit memo, okay? So you can have a credit memo when you're earning money, interest from the bank, and you can have debit memos when you have to pay interest charges, other kinds of things. And that'll appear on the bank statement, but you haven't necessarily recorded it yet in your general journal. All right, so let's go through. This is an example of a bank reconciliation. So let's go through all those procedures again, looking at this graphic, okay? So first we're going to be step 1. We're basically getting all the information together. So we're on step 2 now. We have all the information. Step 2, separate the page in two and set up the headings, bank records, and company records. And it doesn't matter which is there. You can have company on the left, bank on the right. Okay, this is just the way it's done here. Step 3, enter ending balance from the bank statement under the bank record side. Enter the general ledger balance in the company record side. So company records, it's going from the general ledger. For the bank records, it's coming from the bank statement. You can see the two don't agree, and our job is to figure out why. Steps 4, identify, and 5, record. Identify discrepancy items, outstanding checks, late deposits, unrecorded bank charges, debit memos, errors, etc. Anything to explain why the two are different. Okay, so these are examples of outstanding checks. Outstanding checks, we said, are checks that have been recorded in the general ledger, but have not yet been received by the bank, haven't been processed through the bank. So we need to put that on the bank side. We're not adjusting the company's records because we've already recorded those. So remember, if we've already recorded it, it's already, there's a general journal entry for this, we do not record it again. Anything you enter on the company's record side requires a journal entry. Anything on the bank record side does not. Okay, and so it's something to remember. Late deposits. So here we already recorded it as a journal entry, but it hasn't been processed in the bank. Now here we have debit memos. Well, debit memos are on the bank statement, but we haven't yet made journal entries for it. So we need to put that on the company side, and we need to do a journal entry for that. And then any errors. And the errors can be on either side. If you require a new journal entry to fix up the error, then it needs to go on the company's record side. If the error was the bank's and you recorded it correctly, then it needs to go on the bank's side. So errors could be either side. So remember that. You need to put things on the bank side if it hasn't been processed by the bank. And anything on the company side, you are required to do a journal entry for. No journal entry exists for it. So items not yet processed by the bank. Items not yet recorded by the company and require a journal entry. Okay, so that's the way you got to remember that. Now, up at the top, of course, we have our usual who, what, and when, name of company, kind of statement, and date. So remember that as well. Okay, now if you look at the bottom, so some of the things here, remember we got the column system. So anytime you subtotal, you move to the column to the left. subtotal it, bring your total in on the right. You have a single underline under totals, okay, and a double underline on the bottom, so very similar to a balance sheet. And the two amounts, the adjusted balance at the bottom has to equal. The two have to equal out. If they don't, you haven't done your bank reconciliation correct, and you need to continue going. So identifying the discrepancy items. So this is where it's a little bit of detective work. So bank records must be compared item by item with the company's records. When items correspond exactly, check them off as cleared, and you'll have this in computer systems. It'll say cleared. If you're doing it in paper, I often did a highlighter or something, and you could just see from the color that one cleared and which ones aren't cleared. After this is done, the items with no marks are the discrepancy items. When comparing the records, deal with items from the previous month's bank reconciliation. Most of the items will be cleared during the current month. However, there may be a few outstanding. Okay, so there might be a few outstanding. We look at the previous month's bank reconciliation, make sure the stuff that was outstanding before has been dealt with. If not, we need to put that on still. If the two final totals on the reconciliation statement are not equal, you have to complete it until they are equaled and use different colored pens or a different system. But you have to examine everything, and only once the two reconcile do you know that it is correct. So bringing the accounts up to date. Any discrepancy item identified in the bank reconciliation that affects the company record only, not the bank record. Everything on the bank side, essentially, you've already recorded. Anything on the company record side has to be journalized to bring the ledger accounts up to date. And after you do these entries, you should be able to go back and do another bank reconciliation and not have to enter anything on the company side and only put the things on the bank side. And it should equal out. So here we're basically putting in journal entries end of the month to basically make things to record in all the stuff that we basically missed, all the discrepancy items that haven't been recorded in the general journal. Special considerations, certified checks. Now with certified checks, they can never be outstanding. Why? Because as soon as you certify a check, the money is taken out of your account and put into a holding account. And so it's immediately taken out of your bank account as soon as it's certified. You do not wait for someone to go and actually cash it. They could cash it a year later. That's up to the bank. It's already been taken out of your account. So they'll never be outstanding. NSF checks, non-sufficient funds. That's when a person gives you a check, you give it to the bank, and they say that person doesn't have enough money to give you the amount that they said. If this happens near the end of the month, it may be a discrepancy item. But typically what happens is they might have put the money into your account, the bank, and then taken it back out when they realized the other bank said, no, this person doesn't have enough money. And typically they'll also charge you a fee for it on top of that. Okay, so that is it on bank reconciliation. It often requires a lot of practice, but it is one of those internal controls for keeping cash and making things accurate in your statements. All right, so this is Mr. G. Bye for now.